Speaking of due diligence, Alex, a couple of pockets need some good due diligence because one is shown some fantastic quarterly performances, the other one not quite so.
Absolutely. In fact, I'm going to invite Samina to join us because there's two pockets of companies that we're talking about, as Neeraj pointed out, on the editor's cut today. And in case you're tuning in for the first time, editor's cut gets you the story behind the headline. And we're talking about a group of stocks, all of which, most of which I should say, barring a couple of exceptions, have gained at least 40% or more in 2024. And the reason is what we're going to try and understand and help you understand as well. We're going to talk about oil marketing companies first. Of course, it's in focus on account of earnings, HPCL to break down today. But there's also more about the outlook for FY25 and whether the valuations currently price that in. And there's also the wealth managers, which had quite the day yesterday, and they've had 2024 to remember so far at the very least. We'll talk about why that is. Sajid, we'll start, and Samina, with your permission, we'll start with the OMCs first. Yeah. So you've looked at a comparison between FY24 and the factors that worked for these companies then and FY25. And there are a lot more crosses on the list in FY25. I saw this in your cheat sheet.
That's true. Let's look at the PSU oil marketing companies. And most of them have doubled in FY20 in last 12 months, and the PSC index is also almost more than doubled actually in that. So that has been an outperformer in FY24 to set the context. And what was the reason behind it? One, they were there was a favorable gross refining margin, which basically meant that their cash flows were very much positive and very improved there, and that cash generation helped them not only in reducing their debt on a gross level, but also helped in the capex and also in the dividend payout which came in. These 5 items were the key drivers for oil marketing companies or PSUs basically, especially because they are the ones which get influenced by policy decisions there, and that was a big run for them. Things have changed in FY25 as we speak. From a global level, gross refining margins have bottomed in Q1 of FY25. They hit a bottom of 5.4. If I'm not wrong, in Singapore GRMs.
This is plus 7% in the fourth quarter.
Yeah, it was 6.6 average for FY24, and Q4 it was 7.3.
Yeah, okay.
Many of the PSUs which had average GRMs of 7.5 to 9. BPCL had a higher GRM, HPCL 7.5, IOC in the same region. Those GRMs have taken a hit in Q1.
Sajid, a quick aside, just so that everyone understands, why are gross refining margins so important?
Basically, these are the margins at gate level, because when you process a crude and at what price you sell, that the differential is the margin, and that basically gives you the cash flows as well for a refining company.
Obviously, higher the better.
So the higher the margins, it's better. It's benchmarked to Singapore GRMs, and normally Indian refiners have a $2 to $3 premium to Singapore GRMs. That's thumb rule to follow.
But going back to your list and things that are not working, the capex cycle is the only thing that continues. Everything else is negative.
True. So in FY25, if you look at most of the brokerages are talking about the fact that there is going to be weak GRMs. We have seen Singapore GRMs bottoming out in Q1 of this year to $5 or so. And that impact is witnessed in many of the oil PSUs as well, where they have been talking about 5.9 to 7 kind of GRMs compared to 12 and 14, which in many cases which they did in some of the quarters there. So the GRMs on an average will be lower by 20% or so in FY25 compared to FY24. That would lead to a lower cash generation for many of the companies. The good trend that we saw in FY24 was that most of the PSUs are reducing their debt levels on a gross basis. That's going to come down further. There is a price cut in petrol and diesel which happened in March ahead of the elections, and also an LPG cut which happened. That reversals are not going to happen very soon, anytime soon in FY25, because we have 3 major state elections coming in, and that's not going to happen. Under recoveries are to the tune of 600 crores per company per month, which we are talking about. If you just look at IOC, BPCL and HPCL, we're looking at 20 to 24,000 crores of under recoveries in LPG alone, for which nothing has been provided in the budget. And the street is expecting, or the analysts are expecting, that maybe in the second half there will be some provisioning. So far there's nothing in the budget. So what comes in the second half is totally different there. The capex cycle is the only one which is continuing. HPCL has been raising debt for its Rajasthan project. BPCL is looking at a greenfield refinery, and there's a Bina refinery expansion which is there, for which capex is there, and same is the case with IOC, which is there.
What's the bottom line, Sajid?
The bottom line is that it's 25 is going to be an underperformer year for oil PSUs, and if dividend play was one of the things which was in favor of them in FY24, that's going to be lower in FY25. So, you know, from a fundamental point of view, from cash generation point of view, and from a dividend play point of view, it's going to be a muted year for the entire oil PSU basket.
With some major question marks that are yet unanswered, the point that you made on under recoveries.
Under recoveries.
All right, so we've talked about that, and possibly valuations from that perspective stretched. Agreed?
Yeah, it's going into the year, seeing the kind of performance in Q1, it's going to be a stretched valuation for many of them.
Talking about a sector that many have called all-weather, because ultimately everyone wants wealth to grow. Wealth managers have reflected that. The valuations have grown. But what are the factors that are leading to this kind of insane outperformance?
So I think for good reason, right? So you mentioned, let's start with how the stocks have done. You said how they did really well in trade yesterday, and just to put numbers to that, in the last 6 months, so I'll take this between Nuvama, Anand Rathi, Motilal Oswal and 361 WAM. So those are the 4 big players in the listed, wealth management space. Nuvama is up 70% year to date. You've got Anand Rathi that's up 22% year to date. 361 WAM is up 70%, and Motilal Oswal is done 40% year to date. Now, you would imagine that some of these counters, unlike OMCs that have done really well, like Sajid highlighted, the outlook may not be as promising. Contrary to that, in the wealth management space, this is a young industry still, right? We've talked about how the number of accounts that get added in the product side, financialization, the first key beneficiaries apart from the exchanges are also wealth managers. Now, to put out numbers to it, Knight Frank put out a report early this year talking about how they see the affluent HNI segment growing in the range of 7 to 12% over the next 4 to 5 years. Not too many brokerages, remember, cover this sector because it's like covering your peers. So we don't have too much in terms of brokerages sales, but Jefferies believes that the CAGR for the likes of a Nuvama, Anand Rathi, Motilal could be in the range of 20 to 22%, which means they're going to be doubling down every 3.5, 4 years. If you look at that, that sounds pretty promising, right? Because this is a business that is growing significantly. Now let's take you through what's working for them and how the industry dynamics have changed in the last few years. One, the upfront fees that a lot of these wealth managers was focusing on has been gradually coming off. Now that could be thanks to the regulator, which is actually a good thing for some of these firms. And now what you're seeing is these organizations are earning on trail income. Trail income is what you get when you encourage or when you have an investor who's invested in a mutual fund, for example. Mutual funds pay out a fee. And that trail income is generally sticky because even if a market is doing okay, if the fund is not underperforming grossly, that income usually lands up staying with the distributor. So trail income has gone up. The other thing these businesses are focusing significantly on is also building up the advisory model. Now, this is a relatively new concept in India. Not too many firms do it in the listed space. The few that do it are, of course, bulking that up as we go along. With advisory as well, generally that piece is sticky because you don't earn on what you're selling, you earn on what you're advising. So you largely act as a consultant. And as your clients' assets grow, the fees that you earn simply grows.
Because it's a percentage, right?
Because it's a percentage of assets that you manage. So you've got increase in advisory fee. Advisory fee is also a big input that goes into average recurring revenue. So that is revenue that just keeps getting bumped up year on year. You may add a client this year, their wallet share increases the following year, you add new clients, and you just pretty much keep carrying on, right? And working on the base that keeps getting higher. So average revenue rate was about 40 to 50% 3 years ago. That stands at 60 to 65% and is expected to go up to 75 to 80% by FY26.
And the stickiness of that is quite significant.
It stays, it doesn't go. The other thing that's also worked for this sector is the number of IPOs. What we forget is a lot of people in the wealth advisory space also land up selling unlisted equities. The fees on unlisted equities is also fairly significant. So that too has contributed to their performance, generally speaking. Apart from that, a few factors that I saw that has been laid out in Knight Frank's report is the ultra HNI segment is poised for growth because we are at that cusp where previous generations have made significant wealth. So intergenerational transfer is currently taking place over the next 3 to 5 years. You've also got increased interest in complex products. So all this talk about financialization, increasing household savings, operational efficiency, spending better, millennials who don't really want to invest in, physical assets, they prefer financial assets, is all going to help the sector. And now people want to invest even internationally. So these are complex products that Indians are interested in, which helps fund wealth managers such as this. And also evolution from a pure play, physical, interpersonal to tech getting involved, right? Tech is also changing the game. I mean, I don't know if you know, but you saw the kind of valuation Deserve got. It's a pure play advisory on tech. So that's the other big positive. Now, while all of this is great, we know the stocks have run up. Just to put this in perspective, they don't actually come very expensive.
Oh, okay.
Interesting, right? So apart from Anand Rathi, which is an outlier, it's at 63 times price to earnings. But remember, Anand Rathi in the last 1 month has actually corrected.
Yeah.
Which goes to show you that the markets have seen this and they are ensuring that that valuation comes off eventually.
Yeah.
The guys that look good and have done really well is Nuvama. So Nuvama's stock performance has been phenomenal and it's actually very well priced. It's priced at 29 times, which is not too expensive. Markets have recognized that. The stock has gone up. So I think we're being very mature in how we are treating these companies very independently. 360 VAM is expensive, 48 times, and you've got Motilal Oswal that hasn't done very much because they've largely been a brokering business, right? So they're still in the transition phase of saying, we are a wealth manager, we are looking at private banking, it's the ultra HNI. So they're available cheap, and if I had to put a bet on this, I think Motilal may be the next big thing because the growth that they're anticipating is not in the price just yet. So,
and just to add, a lot of broking firms are now looking at wealth management as one of the verticals. Angel is looking at one because they're going to see a dwindling brokerage income coming as impact on F&O is going to come in. There's also a new thing which is going to come in, the new asset class, which is between about 10 lakhs. And I'm sure a lot of wealth firms would be targeting that license. So because between 10 and 25, there's a big gap. And
10 and 50, Sajid.
25, 25 for PMS and 50,
no, 50 for
PMS. So 10 and 50, there's a big gap, and that big gap
plugged in.
Is getting plugged because there's an informal market which is getting formed for
which
that.
Which will get regularized now. Also, I think the fact that wealth, like you said, is really where the alpha is because this is sticky money, right? They're only going to get bigger and better. Unlike brokerages, which is thin margins, it's a heavy top line business, but margins are paper thin. Is also, I haven't read this, but this is what I've been hearing. You also the new rich in India now. There's this new emerging segment where there are people who've gotten wealthier. All these people who made money over the last 3 to 5 years in the equity markets, even if there is a downturn, so I think what they very commonly say is that for a wealth manager, the best times are in a downturn. Because when things are looking great, everybody thinks they can beat the markets. It's only in a bad market when wealth managers actually start picking up clients on the go. So
and that's what a worry for the regulators as well, right? Of the household savings
have been dropping,
dropping.
And that is a conversation.
Equity and mutual funds have gone up from 35.
That is a conversation for another day. I think we've talked about wealth management, and you let us know what you think about the potential for this business, whether it's in the price and what you would be picking up.